Hello accounts people, time to go back to our financial statements. So now we're going to focus on the statement of financial position. We've had a look at extended trial balance, statement of profit or loss. We're still on sole traders, partnerships and limited companies. We're still using the same basic figures and the adjustments for the company structure will be evident. Sole traders again, preparing them for the individuals involved, so we'll see that more in this one, and even when we get to the bottom it won't show quite as much how much is being hidden as a statement of profit or loss. So when we look at our template we're going to fill in, this first section, we'll hide these to make it easier, is our assets. And our non-current assets, our main assets, our fixed assets as they used to be called. But sole traders and the business are the same legal entity, so effectively these are the possessions of the sole trader. Hence they are more interested in the value of it and the breakdown of that value, so we may even see more rows than we would see on a limited company where you have a row for each class of asset, because investors in a business are interested in the final figure, the one that will come down here, not the breakdown, although they might be given that in the notes. And they're interested in how much profits and how much returns they're going to get. So on with this one then. So the assets, the machinery cost us 58,400. It was depreciated up to 35,040, and we can double check it's already on the bottom actually, but cost minus accumulated depreciation is the carrying amount. The cost of the motor vehicles, 22,100. Accumulated depreciation. And take the accumulated depreciation off the cost to get the carrying amount. Our inventories then, so common mistake, but we're not going to do it now because we've only got the columns for the sole trader, is to pick up the opening inventory. We're interested in the debit entry, the closing inventory, because the balance sheet is there, and that went wrong because I messed about. That's the value of the closing inventory. Statement of financial positions are due a particular date in time, hence it's the closing inventory. So these workings out are done slightly differently on different exam questions. We're going to take the receivables, take off the allowance for doubtful debts and come to a final number. You might not have to do that, you might just put the final number in. And if it doesn't balance by that final number, it's an easy one to spot what you've missed off. So there's a sales ledger control account. I want this as a minus. So let's put 0 minus in. And it's the allowance, not the adjustment. Let's add the two together. 17,400 minus 348, 17,052. Prepayment sometimes below the bank, different accountants. That's an asset and the bank. There we are, and it's adding up as we go, complete with a spare row just to try and confuse you. So our current assets added up to 38,632. Current liabilities are in the column to the left. Well, they're credits, those are debits, so it's nothing to do with debits and credits, it's simply in a different column for layout purposes to avoid confusion. Payables, accruals, 31, and VAT. Those are liabilities we've got to pay in the near future. Our current liabilities adding up to 55,900. So this next column, net current assets, next row, or working capital as it's sometimes known, is our current assets minus our current liabilities. So net current assets, that one minus that one, and then our net assets, we add that figure to our non-current assets. And that's our top half done. So that has to be mirrored by the equity or finance in a business, equity for limited companies, capital drawings and profits for the year for a sole trader. Row 6. Drawings, we want it to be a minus figure because this is the owner taking out their own capital. And then profits for the year is our profits in the credit figure, and that now balances off to the net assets. So we've balanced off, and we've got the useful information in terms of net current assets, working capital and net assets that some formats don't have. Very traditional. This looks just like the old-fashioned balance sheet, and it is in balance sheet order. If we're starting to use international accounting standards similar to the limited companies, we'd have put the finance by and a non-current liability if we had a bank loan or something above the current liability, so it's non-current, current, it could be non-current and current. That's just somebody doing it slightly different because we're not tightly governed by international accounting standards. The purposes of this document is to give information to our sole trader and partners. So the partners get very much the same information. The top half looks exactly the same, which is why I put it in again, just as with the statement of profit and loss. From there down to there, exactly the same. There's no reason for it to be any different. But now we've got a finance by section that's slightly different. We've got the vertical format here, the horizontal format there. Both occur in AAT exams. They're both perfectly okay. That number there will be the same as that number down there. It's just two different ways of doing the same thing. So Margaret's capital was in that cell, which means keyboard playing it. Yeah, no it's not. And I can just add those up. So that's the total capital involved at 60,000, and then the current accounts just pick up the one, pick the other two up, subtotal them, and then of course the totals in fact it's not 025, it's 030, that's better. 65,407 balances off the net assets in the same way as the sole traders did, but showing the breakdown of capital and current accounts. These ones just a different way of doing the same thing, exactly the same numbers, they're going to add up to exactly the same weight, so I'm just going to type them in. And then they just need adding up. There we are, 65,407, the same. So two different ways, both perfectly valid. But our limited companies will look quite differently. So one column, the same as profit or loss. We would expect to see in our annual report another column showing the previous years, and again we can hide the ones that we don't need because we only need the statement of financial position columns. So just like the statement of profit and loss, we're going to have multiple items in some of these categories, starting off here because our property, plant and equipment is going to be all the numbers added together. You may see more than one row of different classes where it matters, but the property, plant and equipment is Machinery at cost plus motor vehicles at cost minus the 2 lots of accumulated depreciation. Comes to the same number, less information, but that's fine for shareholders at annual general meeting. There's our inventory, that doesn't change, but the receivables does, because although our main receivable is our sales ledger control account, and we're going to take off the allowance for doubtful debts, because although it's a credit entry, it's a reduction in the value of our receivables, not a liability by itself. There's one we're going to add into this from the bottom, the prepayment. Don't think shareholders are really bothered about prepayments. And then cash and cash equivalents. Doesn't change. So our current assets will add up 38,225, and our total assets there's something not right there. Oh no, that's not the right number. What's gone wrong? That's H28. Oh, I've done it again. Keyboard. I've missed out the letter there, so it came up as 33, not I33. H10, still not right. Minus I16 plus H. That's the right amount. Advantage of doing it on a spreadsheet, of course, when we came down to the bottom, if it hadn't added up, we'd soon be able to work out why. Share capital, that's straightforward. Retained earnings is the 2, it's the opening balance as per the trial balance and the profit figure. The new retained earnings, effectively the money that has been left in the business. There's no evaluation reserves. That's most of the balancing act. There's no bank loan, but that's the way it would be if there was one. Current liabilities, trade and other payables. Well, what do we owe? We owe money to purchase ledger control account. We've also got an accrual, and our VAT could go in trade and other payables or tax liabilities, depending on the wording, depending on our accounting concepts, principles, statements, as long as we're consistent and do it the same every year. I'm going to put it in here and just put corporation tax for tax liability. So it adds up to 10,000. Total liabilities is the non-current liability plus the current liability, and then total equity and liability is the equity bit plus the total liabilities, and that balances out the total assets of the business. A little bit of variation sometimes in the wording in the categories here, but apart from that, pretty much one column, very very simple. If you were a multi-billion pound company, your statement of financial position would look exactly the same except with different numbers, and it would have thousands or billions on the top. It wouldn't necessarily have that many more rows or detail, but what you then have to do is provide lots of notes and a breakdown. They are part of a set of financial statements. Certainly some I've looked at recently 4 or 5 pages of financial statements, including the 2 that don't apply to sole traders and partners, and then 28 pages of notes explaining it all.